After a complicated 2022, markets seem to be weathering the storms coming their way quite well in 2023. Looking back, 2023 had its loads of challenges. From a macroeconomic perspective, the current market conditions are conducive to lower equity volatility. Inflation is gradually going down as the base effect of energy and agricultural prices are wearing off, and central banks seem to have taken the measure of inflation. We remain cautiously optimistic about the economic cycle. We do not favor highly cyclical stocks, but well-capitalized and capital-disciplined sectors and stocks. We also continue to see value in sectors such as financials, which benefit from the higher base rates across the globe. We continue to believe that the debt markets, government debt and corporate credit, offer healthy levels of yield. Finally, defensive assets such as gold can be attractive in the context of a diversified portfolio. We also believe that current volatility in the equity and FX markets can be exploited through structured products. The risk we highlighted last month about the US legislators not being able to vote on an increase of the debt ceiling has actually not materialized. Other than this, we continue seeing two main risks: a policy mistake by a central bank provoking a panic in the financial markets, and a confidence crisis from investors in the strength of the global economic cycle. We are adding a third risk this month, namely a marked slowdown in economic output that would undoubtedly send markets crashing if it were to materialize. Last month, we were looking at companies with the ability to rationalize and reduce their use of natural resources, as well as companies that would benefit from an aging world population. We still believe that these themes are valid and are complementing our recommendation this month with two main macroeconomic themes. For one, the change of economic leadership in Europe with a combination of Brexit and the war in Russia that makes a new economic order emerge in Europe. Southern states, France or Switzerland, seem to be in a good position to benefit from the slowdowns observed in the UK and German economies. And for second, companies participating in facilitating deglobalization are, in our view, going to benefit from the regionalization of global trade and the emergence of a multipolar world. Elsewhere, we start being cautious on equity volatility, and we believe that the current low levels of implied volatility present an upside risk. As a result, we are careful of investing in products selling options as a primary mean of generating yield, as we believe that there will be better entry points for such products later in the year. Finally, we believe that the tech sector offers an interesting pattern. With an inverse correlation to the current rate hike cycle, it's an interesting sector to hold or buy ahead of central banks becoming less aggressive with increasing their leading rates. Please be in touch with your Lynceus point of contact to explore further how to take advantage of current market conditions.